Welcome back to the Deep Dive. Today, we're wading into Forex trading. It can be complex, definitely fascinating. We've got all the material you shared, articles, research, notes, and our mission really is to unpack it all.
Yeah, cut through the noise.
Exactly. Pull out the key stuff, the insights, and just get a clearer picture of what it actually takes to, trade effectively.
It's a good goal because it's a world many jump into with, let's say, very high hopes.
Fueled by myths sometimes.
Oh, definitely. And the reality, as these sources show pretty clearly, is, it's much tougher, much more nuanced than people think.
Okay, let's start right there then. Why is it so tough? The material talks about a lot of people struggling or maybe just stopping.
Right. And one interesting point that comes through is this idea that maybe it's less a failure rate for committed people and more of a high dropout rate. Meaning lots of people start with, frankly, unrealistic expectations. They see it as a way to get rich quick, maybe.
Yeah, you see those ads.
Exactly. So they skip the vital steps. They don't put in the real work, the learning. They lack structure.
So it looks simple, clicking buy or sell, but underneath.
It's incredibly complex, understanding the market dynamics, building good habits that take serious discipline, a lot of what the sources call sweat equity.
Right.
So people quit. They quit early because they never really got past that initial kind of chaotic phase.
Okay, so if you don't want to be one of the dropouts, you need that structure. You need a plan.
Absolutely. That's the bedrock. The sources are unanimous. You must build a solid trading plan before you even think about trading.
And what goes into that plan? What are the essentials?
Well, basically everything. Your strategy, obviously technical, fundamental, maybe a mix.
Okay.
Your specific rules for getting in a trade, and just as importantly, getting out.
Exit tactics.
Crucial. Plus your risk management rules and how you'll size your positions. It's your roadmap, essentially, your guide through the volatility.
And alongside the plan itself, the sources really emphasize expectations, right? Being realistic.
Hugely important. You have to accept that risk is inherent. You will have losses.
No way around it.
None. So avoiding that chase for quick buck or putting way too much capital on one single idea, that's critical. That whole get-rich-quick mindset, that's probably the fastest way to become one of those statistics.
Right. Okay, so plan, check. Realistic expectations. Check. Now you actually need to understand the market itself. The sources talk about two main analysis approaches.
That's right. Fundamental analysis and technical analysis.
Let's break those down. Fundamentals first.
Okay. So fundamental analysis is about assessing, say, a currency's strength by looking at the underlying economic factors of the countries involved.
Like what sort of factors?
Things like central bank interest rates, inflation figures, GDP growth, employment numbers, even broader things like, consumer confidence or major political news.
Lots of events, yeah.
Or even extreme weather if it impacts the economy significantly. You're looking for the reason why demand for a currency might shift.
So it's the why behind the price moves.
Yeah.
Based on the real world.
Exactly. Fundamental traders look for those catalysts. The sources give an example. If a country releases really poor economic data, big institutions might downgrade their view of that currency, demand drops, and the currency weakens. It becomes bearish.
Got it. Okay, so that's fundamentals. Technical analysis then is different.
Completely different focus. Technical analysis looks purely at price action.
Just the charts.
Pretty much. Charts, historical price data, and various indicators derived from that data. The idea is to spot patterns, trends, potential turning points directly from the market's behavior.
So less about why it happened, more about what happened and what might happen next based on past behavior.
Precisely. It's studying the market's own footprint, you could say. And as the sources point out, strategies can use just one type, or often they combine elements of both fundamental and technical analysis.
And the type of analysis often lines up with the strategy you choose.
Yeah, there's often a strong link. Which I guess brings us nicely to the actual strategies themselves. The material covered a whole bunch.
It did. Let's start with scalping. Sounds intense.
It is very intense. Scalping means making lots of trades for very short durations, maybe just minutes, sometimes even seconds.
Wow.
The goal isn't big wins. It's capturing tiny price movements, just a few pips over and over again.
So lots of small profits add up.
That's the idea. And you have to be incredibly disciplined about cutting losses instantly, even tiny losses.
Sounds like it needs a certain personality type.
Definitely. Quick decisions under pressure, very comfortable with numbers, and often scalpers use higher leverage to make those tiny moves worthwhile financially.
Which increases the risk, of course.
Massively, yeah. They also tend to focus very intensely on just one or maybe a couple of highly liquid markets, like EUR/USD.
Okay, what about something maybe a bit longer term? Trend trading.
Right. This is probably one of the most intuitive styles. You basically try to identify the dominant market direction, the trend, and trade with it.
Go with the flow.
Exactly. If the market's clearly moving up, you look for chances to buy or go long. If it's heading down, you look for chances to sell or go short.
What tools do they use?
Often, momentum indicators help identify the strength of a trend. But, and the sources make a good point here, you have to be careful. Markets can stay overbought or oversold, according to an indicator, for a long, long time.
So the indicator isn't a magic bullet.
Far from it. It's just one piece of the puzzle.
Okay. Next up, range trading.
This is more of a price action strategy. It works best when a market isn't trending strongly, but is instead bouncing between two clear levels.
Like a ceiling and a floor.
Precisely.
So
Support the floor and resistance, the ceiling. Range traders identify these levels and look to, well, buy near the support level and sell near the resistance level.
kind of like ping pong.
Sort of, yeah. They use indicators maybe to help time the entries and exits within that defined range or channel.
What about news trading? Sounds like you just trade when big news hits.
Well, yes and no. The sources add some important nuance. It's not about trading every news snippet.
Right.
It's mainly focused on significant scheduled economic events. Things like central bank interest rate decisions, inflation reports, employment data, stuff where you know when it's coming out.
Because those cause predictable volatility.
High potential for volatility, yes. But the key insight from the material is how you trade it. It's not just betting on movement.
Okay.
You're trying to anticipate the market's reaction to the news compared to expectations. So, for instance, if inflation comes in much higher than analysts predicted, that might be seen as a positive surprise for that currency.
It's the surprise element.
Often, yes. The sources also mention looking for data that falls way outside the historical norm for that release. Those are the numbers most likely to trigger a really sharp move. The bottom line is trade because you think you have an edge based on the potential impact, not just because the market is suddenly whipping around.
Makes sense. Avoid chasing the chaos. Okay. Retracement trading. What's that?
This one's interesting. You're actually trading against the immediate short-term move, but within the context of a larger trend.
How does that work?
So imagine a market is in a clear uptrend. Prices don't usually go up in a straight line, right? They pull back, they dip temporarily. That dip is a retracement. Retracement traders see these pullbacks as opportunities to join the main uptrend, but at a better, lower price than if they just chased the highs.
Buying the dip in an uptrend.
Essentially, yes.
Yeah.
Or selling the rally in a downtrend. The big challenge, though, as the sources point out, is telling the difference between a temporary pullback and the start of a full trend reversal.
Yeah, that sounds tricky. How do they try to figure that out?
Technical tools are key here. Fibonacci retracements are very commonly used.
Fibonacci, like the number sequence.
Based on it, yeah. The idea is that these retracements often stall or reverse around specific mathematical ratios derived from that sequence, like 38.2%, 50%, 61.8% of the previous move. So traders watch for price action around these levels. Maybe a candle pattern forms signaling the pullback is ending. They might then enter, often placing their stop loss just beyond that level or targeting another Fibonacci level for profit. The material actually mentioned a GBP/USD chart example showing this.
Fascinating how those ratios pop up. Okay, next one. Breakout trading.
Right. This is kind of the opposite of range trading. Instead of trading inside the range,
You wait for it to break.
exactly. You wait for the price to push decisively through a known support or resistance level. The thinking is that this breakout signals the start of a new move in that direction.
So if breaks resistance, you buy. Breaks support, you sell.
That's the basic idea. How you enter varies. Some jump in the moment it breaks. Others, as the sources suggest, are more cautious. They might wait for, say, a candle to close beyond the level, or for price to come back and retest the broken level before entering.
Why wait?
Because of false breakouts. They happen all the time. Price pokes through the level, sucks traders in, and then snaps right back into the range. Yeah. So that waiting for confirmation is a risk management technique. But even then, strong stop losses are absolutely critical for breakout strategies. The example given was going short EUR/USD after it broke below a key support.
Okay, last one on the list. Algorithmic trading. algo trading. Sounds very high-tech.
It is. This is using computer programs' algorithms to analyze market data and execute trades automatically based on quantitative methods, often technical analysis patterns or statistical relationships programmed into the code.
What are the advantages? The sources mentioned quite a few.
Yeah, the big ones are removing emotion, fear, and greed from the actual decision-making.
That's huge.
It is. Also, speed and efficiency of execution. Computers react instantly. They can monitor and analyze way more data across many markets simultaneously than a human ever could.
Diversification, too, then.
Right. And consistency, the algorithm just follows its rules, period. Plus, it makes backtesting ideas on historical data much easier and more rigorous.
Did the research say anything about how well these algos actually perform?
Yes, there was a specific mention of research using AI, specifically deep Q learning.
Okay, what's that?
It's a type of machine learning reinforcement learning, where the AI basically learns through trial and error. It tries things, gets rewards for good outcomes like profit, penalties for bad ones, and optimizes its strategy over time.
And the results?
The research suggested these AI agents could potentially outperform not just a simple buy and hold strategy, but even experienced human traders.
Wow, that's quite something. It suggests framing trading as a learning problem for a machine might bypass some of our human flaws.
It certainly raises interesting questions about where trading might be headed and what constitutes an edge these days. It's not just pattern recognition, it's adaptive learning without the emotional baggage.
Speaking of baggage and flaws, all these strategies, algo or human, they all depend on risk management, right? The sources were really clear on this.
Absolutely non-negotiable. Paramount. The material hammers this home. You must decide your risk limit, how much you're willing to lose before you enter any trade. Every single financial instrument has risk. Ignoring that is, well, financial suicide.
And a key concept here is the risk-reward ratio.
Yes, absolutely fundamental for long-term survival, let alone profitability. The core idea is simple. Your winning trades need to be significantly bigger than your losing trades.
So even if you lose more often than you win,
you can still come out ahead if your winners are, say, 3 times larger than your losers. A common target mention is 1 to 3 or better. Risk $1 to make 3.
Makes sense. Risking $100 to potentially make $400, that's 1 to 4.
Exactly. That gives you a buffer. So it's not just about being right. It's about the magnitude of being right versus being wrong.
And managing risk isn't just one thing, is it? It depends on the situation.
Right. How you manage risk for one single trade is different from managing risk across multiple open positions or across your entire trading portfolio.
Let's start with a single trade level, position sizing. How big should the trade be?
This is crucial. The sources mention several techniques, things like unit per fixed amount or using a percentage of your margin. A more sophisticated one is percentage volatility.
Percentage volatility. How does that work?
It often uses a tool called the average true range, or ATR. ATR measures how much an instrument typically moves in a day on average.
Okay.
So using percentage volatility sizing means you might take a smaller position size on a very volatile instrument and a larger size on a less volatile one to try and keep the potential dollar risk of the trade roughly the same, regardless of the instrument's typical swings.
Adjusting for how choppy it is. Smart. What about percentage risk?
Very common, very effective. You simply decide you'll never risk more than a fixed percentage of your total trading capital on any single trade. Often it's something conservative, like 1% or 2%.
So if you have $10,000, you risk no more than $100 or $200 per trade.
Exactly. It protects you from catastrophic losses on one bad call. The sources even touch on advanced concepts like adjusting that percentage using formulas like Kelly's criterion, which tries to optimize bet size based on your winning probability and risk reward.
Complex stuff, but the core idea is having a rule.
Absolutely. A disciplined rule for sizing. And the sources note that different sizing methods combined with how you define your capital can lead to quite different results over time. They also mention some pros, once they really master their strategy and leverage, might use a fixed dollar risk, just risking the same dollar amount each time, an amount they're comfortable losing.
Okay, scaling up now. Portfolio risk. When you have lots of trades or assets.
Right. Now you need more advanced statistical tools because the interactions between the assets matter. Concepts like variance, how spread out are the returns of one asset, and covariance, how do the returns of 2 assets tend to move together.
That sounds like diversification.
It's the mathematical basis for it. Positive covariance means they move together, less diversification. Negative means they move oppositely, more diversification benefit, potentially smoothing out returns.
And if you have many assets.
You use what's called a variance-covariance matrix to see all those relationships. Financial firms use these concepts extensively. The sources also bring up metrics like value at risk VAR and cumulative VAR, or CVAR.
VAR, what's that estimating?
VAR tries to estimate the maximum potential loss on a portfolio over a given time period at a certain confidence level based on historical data. So a bank might calculate its one-day 99% VAR is $10 million, meaning they expect to lose more than $10 million on only 1% of trading days. CVAR goes a step further and looks at the average loss when you exceed the VAR threshold.
So these are big picture risk gauges for institutions.
Exactly, used to assess risk across large, diverse trading operations.
The sources also touched on a different kind of risk, operational risk, specifically in big financial institutions trading Forex.
Yeah, this isn't about market moves, but about the risks in the bank's own processes. Like what?
Things like ensuring trades are confirmed and affirmed super quickly. Ideally within 2 hours, the sources say, definitely by end of day. And having clear escalation if a trade isn't confirmed.
What else? Keeping track of the money.
Crucial. Reconciling nostro accounts. Those are the accounts a bank holds in foreign currency at another bank, needs to be done promptly, no later than the day after settlement.
Why so fast?
To know your true cash position, obviously, but also to spot problems early. If money isn't where it's supposed to be, it could signal a counterparty is in trouble.
And internal checks.
Absolutely vital.
Yeah.
Daily valuation of all trading positions by staff who are completely separate from the traders themselves.
Independent verification.
Yes, and checked against independent market data sources. It all comes down to segregation of duties. The person doing the trade shouldn't be the person confirming it, settling it, or valuing it. Prevents errors and fraud.
Wow. So risk management it's deep. From your personal 1% rule on a trade all the way up to institutional plumbing. It truly underpins everything. No strategy works long-term without solid risk management at every level.
But even with the best plan, the best rules,
Yeah.
there's still the person clicking the button or overseeing the algo. The human element. The sources really hit this hard.
Oh, yeah. This is where so many traders stumble, according to the material. Emotions, fear, greed, hope, regret. They have a massive impact on decision-making and performance.
You can measure this stuff.
Apparently, yes. The sources mention psychophysiological evidence changes in skin conductance, heart rate variability being linked to trading outcomes in studies. There's also this cognitive bias called the illusion of control.
Illusion of control.
Where traders, especially after a few wins, might subconsciously feel they have more influence over random market outcomes than they actually do.
So it feels like skill, but luck played a big part.
Could be. And it makes you take bigger risks, maybe. It sounds like trading is often a battle against your own instincts and biases.
Very much so. And the sources tie poor psychological management directly to why many fail. Constantly chasing the next hot strategy, never mastering one, deviating from their own trading plan in the heat of the moment.
Impulse trading.
Right. Trading based on gut feel instead of analysis.
Yeah.
And those unrealistic expectations, again, always searching for some kind of holy grail system that never loses.
Which doesn't exist.
Exactly.
Yeah.
So all the chart reading skills, the economic knowledge, it can all be undermined by your own psychology.
That's the message. Passion helps, but it's not enough. Consistency comes from deliberate practice, improving specific skills, and psychological mastery is arguably the hardest skill of all. That whole 90% failure rate idea, maybe, as we said, it's more that people drop out because they don't treat it seriously like a business and they don't manage themselves.
Which brings us to a really stark point the sources made, specifically about Forex. It's a zero-sum game.
Yeah, this is fundamental. If you ignore broker costs for a moment, in Forex, for every winner, there has to be a loser on the other side of that trade. Money is just transferred.
So unlike the stock market, where theoretically the whole pie can grow and many people can profit as companies create value.
Right. Forex isn't like that. It's a direct transfer of wealth from one participant to another, which means the big, sophisticated players, the smart money, as the material calls them.
They need someone else to be wrong.
They need other traders, often retail traders, to lose money so they can make money. It's the nature of the game.
That's a pretty sobering thought. It implies that success isn't just about predicting the market.
It's also about understanding where and why other traders are likely to be wrong or forced out of their positions.
Their mistakes become your opportunity.
That's the angle presented. Knowing where clusters of stop-loss orders might be, for example. The sources give that domino effect example. Lots of people are short, price ticks up a bit, hits some stops,
Forcing them to buy back.
which pushes the price higher, hitting more stops, forcing more buying. Suddenly, you get a sharp spike seemingly out of nowhere.
Not driven by news, but by other traders' pain.
Exactly. Driven by forced liquidations and the emotional reactions of those caught on the wrong side. Learning to potentially anticipate or even utilize those moments becomes a key skill in a zero-sum arena.
Okay. Given all this complexity, strategies, risk, psychology, the zero-sum nature, how does anyone actually figure out what works for them? How do you find your way?
Yeah, that's the million-dollar question, isn't it? The answer the sources give is clear. Testing and tracking, absolutely essential, yet so often skipped.
Which contributes to the dropout rate again.
You bet. Almost nobody finds a winning approach straight out of the gate. You have to test.
What's the safe way?
Start with demo accounts, paper trading, or use backtesting software to run your strategy rules over historical price data. Do it in a completely risk-free environment first.
Get proof of concept before risking real cash.
Exactly. Test the plan, test the strategy rules, see how it performs on paper across different market conditions.
And then, even when you go live with real money.
The testing doesn't stop, and tracking becomes critical. You have to monitor your performance objectively. The sources suggest tracking month by month for at least a year, ideally.
How do you track?
There are platforms like MIFXbook, specifically for Forex, that can connect to your account and give you detailed stats. Performance metrics, drawdown, win rate, risk-reward achieved. For stocks or CFDs, you'd rely more on your brokerage statements and maybe a spreadsheet.
Why is that tracking so important?
Because it moves you away from subjective feelings, I feel like I'm doing well, to objective data, what's actually working, where are the leaks. It lets you refine based on evidence, not emotion.
And markets change too, right? A strategy might stop working.
Absolutely. What worked last year might not work next year. Market dynamics shift, volatility changes, so traders have to adapt, evolve. It's a constant cycle. Trade, track, analyze, adjust, test again. It reinforces that achieving consistency takes time, patience, and that persistent effort.
Right, so we've really covered a lot of ground here, from the absolute necessity of a trading plan,
The foundation?
through a whole menu of different strategies, from scalping to algos,
Each with its own style and risks.
then diving deep into risk management, which is clearly huge on multiple levels.
From single trades to institutional processes.
Facing the reality of trade psychology, the internal battle,
Often the biggest battle.
and finally grappling with that stark, zero-sum nature of Forex, where your gain is literally someone else's loss.
Yeah, we tried to pull out those core ideas, the real-world challenges highlighted in all that material you provided, hopefully giving you a much more grounded view of what trading really involves.
It definitely paints a clearer, maybe more sobering picture. Which leads to a final thought for you to chew on. Given everything we've discussed, especially the zero-sum game aspect, where smart money explicitly needs others to lose, and how profoundly psychology and managing emotions impact success according to the sources, is being consistently profitable in trading maybe less about having a crystal ball for market direction, and perhaps much more about understanding the predictable ways humans behave under pressure and capitalizing on that.